In 2014, the pace at which the infrastructure was getting constructed, the roads that were getting constructed were 12 kilometers a day. And in 2018, that is 27 kilometers a day. Is it Modi ji's government? Is it the overall reforms that have been put in place? मुझे मालूम नहीं, मैं सिर्फ numbers आपको बता रहा हूँ. India's contribution to the GDP in 2014 was 2.46%, and in 2018, the number could be here or there, it is 3.08%. The forex reserves that India had 4 years ago were 300 billion USD. And in last year, that reserves, basically, the number stood at 420 billion USD. The FII investment that was done in 2014 was 36 billion USD. The FII investment that is done in 2018 is 60 billion USD. There were 32% of the villages in India, staggering, huh? There are 32% of the villages in India that did not have electricity in 2014. In 2018, the number is 0%. That means every village in this given country is now electrified. It is connected with electricity. Such is the pace at which the macroeconomic developments are taking place. But हम लोगों से क्या लेना देना? अब GDP उतना contribute कर रहा है, या roads construct हो रही हैं 27 kilometer per day के हिसाब से, तो मुझे क्या लेना देना? And these are the questions that you and I keep asking. But there is a very fine connect between micro and macroeconomic variables at play and the way that we invest. There is a person who's aptly suited to explain this to us, and I don't mind saying this, that his is one session that I really wait for, because the last session that he delivered to us, I had actually gone through the recordings for at least 3 times. And he happens to be one of my favorites, whose session I do really enjoy. He is a serial entrepreneur, a person who's established many businesses, leading from the front. Just to mention a few, in the area of education and training, if you've heard of EduLite, that is his business venture. If you've heard about a business in the area of HR services, it is Searchlight. If you've heard about automobiles, I'm sure you have heard about Hot Wheels. And if you've heard about wealth management, you would have heard about Equentis. We are very happy that this person serves as an independent director with us at Research and Ranking, and he is the right person to take us through the next session on what exactly these macro and microeconomic variables mean to us as investors. Put your hands together for my favorite, Jeetendra Nair.
Happy afternoon to all the distinguished ladies and gentlemen in the room. And thank you very much, Sanjeev, for that rather pompous introduction about me. Thank you so much. Team Research and Ranking, all my colleagues, all of us join me in wishing all of you all and your loved ones a very, very happy 2019. May God bless you with a wonderful year, especially in the stock markets. Yeah. So when I was requested to speak about taking a session today, we at the leadership team were thinking about what could potentially be a good topic for discussion today. Because the fact is that we have been revisiting the macro level factors, and the more we see it with a microscopic view, the more we understand the last time that we had derived as a clarity was more relevant, in fact, even more relevant today. So true to the culture of research and ranking, what we decided is, let's look at things which are more relevant and perhaps a little bit of thought weavers that we have in our mind. So we ultimately brought it down to 3 essential aspects that we wish to communicate today over the next 30 odd minutes, which is what Sanjeev has warned me on the side. And those are as follows. One of the first thing that if you look at most of the boardrooms as we discussed today, even when we sit in our own investment decisions, a lot of us are bothered about the fact that ye transaction karne hai, nahi karne, because there's an impending election. And we all want to see if this election is going to have some sort of an impact in the investment decisions that overall the investment fraternity is taking. What we said is now there are differential views. Some say yes, some say no. And we respect the views of everyone and to each his own. But what we said is, let's put together some data. Let's try and see what are the historic evidences of what we have seen in terms of market behavior and market responses to each of the elections over the last 20 years. So we decided to look at 1999 to now. And we have been one of those wonderful democracies where we have seen 4 stable governments. As a matter of fact, we could not have got a better composition because we have had twice the governments have changed. Once there's been a re-election, things like a repeat of the government and things like that. So we have put together, that's the first compartment of a presentation, which you all would be very happy when you see the conclusive evidences of what has been derived as data points. You would be very happy to see the maturity of the stock market. And to a great extent, without sounding very bullish, the reality remains that to a large extent, these markets are immunized to those election periods. The second part, Manish briefly touched upon, which was about how do we live in a world where media is taking an increased mind space to the way we decide, the way we react, the way we respond. What we have said here is, and before I say I wish to qualify, everything that we speak about media is essentially to do about how you use the media in feed in terms of taking your investment decisions. So this is not about media as a whole. This is about media in terms of you taking your investment decisions. Second compartment of the presentation is about media and how potentially one could use that consumption and create your responses. The third essential compartment of this discussion is something which all of you all as part of the investment fraternity, I would seriously recommend you all reading the latest India at 75 report that has come from Niti Aayog. It is something which I believe is one of the best reports created, which is based on strong data points, and we will find it very, very difficult to debate those points because everything is based on facts as they emerge. At the end of it all, perhaps the outcome would be a reinforcement of the thoughts that we have been discussing over time, and perhaps a extension of the conviction that we have about India as an economy and the stock markets as a whole, and research and ranking being a tool which will help you travel the journey of wealth creation in an informed and educated manner. May I, with your permission, start off with the first part. So, broadly, this is what we are going to discuss. The first compartment being elections. We have a good slide for you which talks about how the markets have been. For example, when in the year 1999, when Shri Vajpayee ji, the late Prime Minister of India, when he took over, the stock market at that time, the Nifty levels at that time was 1,400. And when you look at the end of his term, the markets had grown by 31% and with a CAGR of 6%. If you look at when Dr. Manmohan Singh, he took charge in May 2009, the markets were roughly about 1,800, 1,769, and the markets at that point in time grew by 105%. Again with a CAGR of 15.5%. All these presentations will be coming to you as a part of yours, so feel free to take them, but they will in any case come to you. The third aspect is when Dr. Manmohan Singh got re-elected, once again, if you look at the market, it almost doubled at 93%, and it was at about 7,000. And when Modi ji took over in May 14, the markets at that time was at 7,000, and today, as we speak, we have seen a 55% growth in the market with a 10.2% CAGR. So what does this indicate? Somebody as an investor, what I feel is stock markets are exceptionally matured to respond positively to any change, because the reality remains that any government comes in with a vision, any government comes in with a conviction of doing certain things, and more often than not, they've been succeeding. Historically, if you look at the last 20 years, you will see that they have been responding positively to any change in the government, irregardless of whether it's a change of government, irregardless of whether it's a repeat or re-election of the government. This is in no way going to indicate, at least You see research and ranking, every time we say no speculation, only wealth creation. In no way we are giving you an indication of saying this is how it's going to be in future, because those could be speculative. But what we are trying to put on is historic evidences which is documented and available in public domain. But now what all of y'all, if I would be in your place sitting on the other side, what I am keen to know is how would the markets be from here to the next 6 months? The answer is we don't know. But we can always tell you how the markets have behaved, how the markets have responded generally 6 months before your general elections. That's our next slide. If you see, what we have done is we have taken 6 months prior, what was the scenario, and how did it happen on the election day as the government got elected. So let's take the first case. If you look at Mr. Vajpayee's nomination, the markets were at about 1,063, 6 months prior to he becoming the PM. So in that phase, in the run-up to that 6 months, the markets moved to about 1,400. If you look at a significant growth in terms of percentage, if you look at Dr. Manmohan Singh's government, the markets were 6 months prior to that, it was at 1,595, roughly about 1,600, and the markets moved to 1,769, once again in a period of 6 months. If you look at the next, once he got re-elected, at that point in time, the markets were obviously at 3,635, and 6 months prior to that re-election, the markets were moving at 2,800. And mind you, at that point in time, there was a lot of speculation that they would not be getting re-elected, if you go back in history. Once again, if you look at Shri Modi ji's nomination as the Prime Minister, you would see that the market, once again, at that point in time, has grown by nearly 20%. So what does this say? We discussed this briefly in the previous conclave, that if you look at the market pattern, you would have generally observed that as a run-up to elections, markets normally are more positive for various reasons. It is inbuilding a level of positivity into the way it operates. And these are the factors which, as an investor, when we look at it, should it bother me? I don't know. Should it bother me? I don't know. And that's repeatedly the answer that's coming in. But historically, over the last 20 years, if you see, this is the reality, that markets have been positive. And we at least don't believe there are any reasons for any negativity in that sense to come in unless there are great global factors. So, notwithstanding any government, if you see the markets keep going up, irregardless of either a change in government or a re-election of the same, a re-nomination of the same government. And those markets are continuing to be going up and up and up and up. And specifically, if you see, it is even 6 months prior to the elections, the markets have generally gone positive. But what we say internally, and I can only tell you what is being discussed by a wonderful team that we have, and what is being discussed by the wise investment fraternity outside of India as well. The concept of investments, it's a good thing for us to discuss, and obviously it's a lot of public domain discussion about who would come, who would head, what could be the challenges, what could be the combinations. All those aspects will play out in the times to come. But from an investment standpoint, I think what is necessary for all of us is to know that, look, these are all clutters. And all of us should be smart enough to stay away from the clutter, because even if it is giving you a blip upwards, that is not something which is sustainable. Even if it is giving you a blip downwards, that is not something which is sustainable. What is sustainable is the macro factors which drive the economy. And that leads up to what Kunal spoke about, that if you stay focused on the fundamentals, if you stay focused on aspects which actually drive the economy, which could be nearly 1,000 of them, okay, and we are just discussing 7 or 8, and one primary discussion at the moment amongst a lot of us is elections. As far as we are concerned, we are largely immunized to it. From a, even from an individual investment perspective, we are largely immunized to that whole concept of elections, and especially because we have this data. But what we cannot be immunized is about some of those prime factors which take the economy forward. How many of you all were there in the previous conclave? Can you just put the hand up? Okay. So we did discuss this how many of them were there in the first conclave? Okay. So we see a lot of new participations, this time. So at the cost of sounding repetitive for the ones who have been there for the first and second time, let me tell you that the primary factors amongst the various other secondary factors that take the market forward has been mentioned here. We'll take up one by one briefly. One of the first things that drives the economy is the GDP. Manish spoke about it. GDP being the total, the gross consumption of goods and services put together, which determines the way a country goes forward. So in essentially what it talks about is how big is your economy, how big is everything put together, sab mila ke hai kitna, some relevance of that sort. In a normal concept, you would find that when the GDP goes up, the market response is generally very, very positive, okay? Because invariably, it is understood that generally companies grow in economies which are growing. And if you're growing in an economy which is growing, the chances of your growth are substantially higher than if you're trying to grow in an economy which is not growing at a similar rate that is expected. With, like Sanjeev's pointed out a few minutes back, India being rated as one of the topmost economies in the world, okay, and the GDP going consistently up is an indication of the fact that the market response to GDP generally should be positive. This is an explanation of that slide. Now, there is only one challenge when it's not a challenge, but it's one factorization that we should bear in mind. The GDP results typically comes with a lag of 3 months. So invariably, the markets tend to discount that into their current earnings, into their current pricings. And you would see that one of the reasons why we are always hungry for forecast as compared to the previous quarterly results. You would see that coming more and more. The second aspect, you heard the example of two different stocks that Kunal spoke about, crude. Now, India predominantly is an import-based economy. Like Manish pointed out, we just have about 30% of the overall thing, in terms of export. So we are largely an importer of oil. And what this typically means is when your crude prices go up, you have to pay more money for getting the same level of crude in, which essentially puts a lot of pressure on your cash flows. And you would see, invariably, when the crude prices go up, the stock markets have a propensity to respond in the negative. So one of the aspects when you look at your data points on a daily basis or whenever you review your stuff is to see which way is the crude moving. If the crude is getting stable, okay, you would see that, you can see here, the crude price had been at a peak of even 140, and you have seen that's around the time when 2008 happened. And even the recent fluctuation of crude prices, and we have seen some of the lowest troughs also of crude. So this essentially puts a lot of load on you in terms of cash flows. And as an economy, generally, you have a little bit of drain, consequent to which the markets respond in negative. The third aspect, which I'm sure all of us we keep reading, is the exchange rate. This is obviously the rate at which we trade with international countries. At the moment, it's all pegged to the US dollar. So when your currency depreciates, which basically means we have to pay more rupee for getting the dollar, generally what happens is, in a country like India, it puts a lot of load essentially because we have a lot of imports coming in. And our export, even currently, we are, unlike China, not a very, very export-driven market. And consequently, a depreciation of the rupee is leading to extra load on the economy in terms of cash flows, in terms of capital spend, in terms of outlays, and things like that. Because of which the market tend to factor in an element of negativity whenever your rupee is depreciating. And you would have seen consistently rupee is depreciating, notwithstanding, I link it again to the first slide, notwithstanding the government. So these are principles of economics at play, not necessarily any political move. Now, the next aspect is what Manish spoke about, earning per share. And to briefly touch upon his point on the last 4 to 5 years, we have generally not seen too much of increase in the earning per share, which is evident towards the right extreme corner if you observe. We've been in the range of 404 to 445. Wahi range mein hai. That is irregardless of a lot of positive movements, etc., that has happened, and there are a lot of economic factors which is playing. So what does this indicate? When you look at the EPS of Nifty, okay, it indicates the general prosperity of the market, so to speak. So what it says is that It's the total sum of corporate earnings. Okay, all the Nifty put together, typically this is the earning per share that we have. Once again here, our analyst team and our entire research team have the challenge because typically these results come in with a lag. And consequently, a level of forecast once again comes into play. The other aspect is the interest rate. Now, when it comes to interest rate, one of the most important aspects, if you see, is typically when the interest rate goes down, the market is supposed to respond positively. But you will also through the slide see that there have been cases where it has been the inverse, or it has been the converse, where the markets have also responded to the contrary. Okay, having said that, going by the general principles of economics, whenever the interest rates goes down, okay, the element of flexibility and elbow room that a company has substantially increases, because of which the market responds towards it, the index generally responds very, very favorably. Normal mode would be what you see here. When it goes down, the Nifty goes up. So when you have a declining regime, declining interest rate regime, what it helps you is refinance your debts, get money at lesser cost, presuming that your sale price is constant, enhanced margins. There are also certain sectors which are dependent on debt for even sales. A classic example being auto, a classic example being cements. All these kind of industries, when the debt regime goes down, tend to factor in better returns, better earnings, and better elbow room in terms of the overall movement. And consequently, the market response to these prime sectors are also very, very good. The important factors, we just picked up 4 or 5 points. I'm sure there are so many, and I'm sure you also know quite a few. But what we are trying to say is there's no science behind it. I mean, when you say a mathematical formula, 2 minuses make a plus, we have no such formula here which determines which way a stock will move. And hence, these are not scientific in nature. Consequently, a deep research on individual stocks. So what is good for Jack may not be good for Joan. And what is good for Manish may not be good for Jeetendra. And these aspects will come into play. And hence, when you say that, look, all these 7 factors are intact, yet I may not be doing well. And you have certain examples of what, I think Vikas, Ecotech, or something that Kunal spoke about. So you may have all the parameters intact for you, presuming that being the desired model. And yet you may see that some of the stocks have not performed. These are indicative parameters, not absolute in nature. And you will see growing economies having falling companies, and you will have good companies falling in good economies. Because, as I said, at times it could be certain blips which come in, and our rating of a company cannot be based on a quarter or 2 quarters. It is based on the strong fundamentals of so many aspects that they bring in, and the pedigree of their existence over years. The classic example of some of the companies, in addition to what Kunal spoke about, if you see the Nifty has done well, but the company has been down. Tata Steel, Mahindra & Mahindra, Vedanta, these are good companies with very, very strong fundamentals. Okay, and if you look at all the factors have been there, but there have been exceptionally unaccountable factors that came in which took these stocks below what the market was. So the Nifty was doing well, but these companies have been struggling to reach there. So to sum up the first compartment, what are we trying to say? As far as elections are concerned, please take it as a speed breaker on a highway. At best, you may have to pause for a minute, then take your stuff and go forward again. Change gears, move to the next slide. The reality is the market in itself is not considering it as a major event. And I'm saying this on the basis of the first 2 slides that you saw. Be it over a period of last 20 years of the last 4 governments that you have seen, or the 6 months behavioral pattern of these indices over that time. You would see that all these companies have, all these kind of, parameters have been already accounted in. And to sum up, historically, the markets have done good. So if that is one of the parameters that is holding you on from making those transactions, and like the first sentence was made, what does a good investor do in such markets? Something worth 80 rupees, 100 rupees available at 80. So I would latch on to it. And when you choose good companies, the last point was that when you choose good companies, leave it to their management. I'm sure those are very, very competent people who have gone through a very refined process of selection to be at the positions that they are in. So leave it to those good folks. Let them work on those, whatever those trade wars could be, or whatever those inflation indexes could be, etc. Because they are there, because they're meant to be there. So that's the first compartment of elections. I presume that the takeaways have been registered in your minds. The second aspect that we wish to discuss briefly today is about how do we consume media. Media consumption, now we cannot be sounding victimized. And as I said in my initial opening talk, we are looking at media from a standpoint of how are you going to use it for your investment decisions. We are not on all those political debates, this, that, and the other. To each his own, they can all debate as much as they want to. Our discussion here is summed up to how do you use this for investment decisions. So we thought about it, and if you look at it, what's the first challenge? The first challenge in media is that, let's be mindful, we are living in a very, very connected world. And we are living in an exceptionally connected world, so information dissemination has become very, very quick. So by the time you say Jack Robinson, the information is translated to as many people, disseminated to as many people that you want it to be sent to, which unfortunately has become a malice when it comes to the investment industry. So in our fraternity, hum log bhi khabar ke bhuke hain. If you look at it, we don't get news for some time. We get a little restless because that's the behavioral pattern and that's the way our minds are getting developed with so much of information feed. So the biggest challenge is that earlier, if you go back in history just about 8-10 years back, newspapers had the most primary impact on us because you would pick it up in the morning, okay? And the life of that newspaper was for that day. But today, uske baad mein, if you're in a train, car, bus, whatever, the way you travel, you generally don't discuss too many. At best, you discuss what you've read in the newspaper. But today, times have changed. As your positions keep changing after every 2 kilometers, because some other news has come in to cloud the earlier news. And these are aspects that are beyond our control in terms of receiving it. But it's in our control in terms of responding to it. And that's the point we are trying to make through this presentation. The second important aspect is digital media lasting footprints. What do we mean by that? Once again, to go back to that example, once when we took our newspaper, the life of a newspaper was 24 hours. There was no concept of going back and reading Kal Ka newspaper. So everybody had this habit of looking at newspaper today. What is the news for the day? Consumption was temporary, if I may say so, at best 24 hours. Bahut ho gaya in your mind for 2-3 days. But today what's happening is, when you read, the same thing comes to you from 7 different sources. So you're reading it 7 times. You're forwarding it, so you're reading it and forwarding it at times. So the footprint of that news is having a more telling effect and a more lasting effect. So the life of news is increased, in short. The third point is multiple channels. Once upon a time it was just print, then it was print and electronic, then it was print and electronic and voice, radio, then it was print and electronic and social media, then it is print and electronic, social media and a lot of groups, and it keeps increasing. It keeps increasing so much to the extent that at times you have a challenge of, receiving it beyond a point. The fourth aspect is when somebody is printing it or somebody is broadcasting it, okay, in whatever form, there is an element of regulation. They are answerable to so many other people in terms of the quality of the content and the honesty of the content that they have put in. However, when it comes to social media, the news are fairly unregulated. And this becomes a challenge because you don't know what you have got in your inbox is right. For all you know, it's right. But you don't know whether it's right. There is no essential form of validation which is prevailing today to know that. And consequently, you see a lot of responsible companies running the campaigns of fake news versus the right news. Now let's look at the media industry. That's also an industry that has evolved. It's not how it was 10 years back. It's like some of the other industries which has evolved with time. Today in media, what takes you? What takes you forward? You look at all the news channels, they'll say breaking news, first time, hamare idhar, baki sabse pehle. It could be one of the most disturbing news, but they take pride in the fact that that has come to you first. So it's a world where speed is more essential than quality, which is very, very counterintuitive to the whole concept of media because it is presumed that the news that is coming to you has to be the right news. In all fairness to media, they never tom-tommed that social media is one of the methods of our communication. They're using it more as a marketing tool. We, as the investors fraternity, should be mindful that we are responsible for the money that we are investing in the market. And you owe it to yourself more than anybody else to understand that the consumption of this news will be taken with a pinch of salt or a fist of salt, depending on your own individual experiences. The other element is also the corporatization of media industry. Today, big houses have gone into media. I would personally, and this is more my personal judgment, I would personally find it very difficult to believe that I would be funded by X or Y or Z, and I may not have a bias towards that particular group or person or as the case is. And in that context, again, you have to take it from a pinch of salt. Does this recommendation come in with a perspective of some bias that may originate because of certain subjective interest which is ruling the roost? And consequent to it, it's no more only the editors who discuss and decide what has to be relayed. So there's a waning independence phase. What does it all lead to? This black spot, caution. Bach ke rahiye. As much as you can, be sort of immunized to such things. And this is typically that model, my father used to tell about me, sunega sabka, karega apna. In this context, it may be a good thing to do because you can take as much information that you want to from all sources that you can, but use it judiciously by qualifying it through experts. So this summing up what we said, high quantity, too much news coming in. So there are multiple news. So maybe, there are about 7 stocks being recommended to you in the morning. There are another 7 coming to you in the afternoon. And there are another 8 that is coming to you in the evening. It also depends, aapka mood us waqt kya hai. It also depends what is your attention. It also depends what are your primary commitments at that point in time. And invariably, it's also a human behavior that when you get so many, you feel I have to invest in 1 or 2. And you tend to choose a pick on the basis of no research. Similarity. अब 10 बार रस्सी को सांप बोलोगे, एक आध बार आप सोचने लगते हुए सांप ही तो नहीं है. So this is a very, very psychological way of human response. So when you get similar information 10 times, you start believing that it perhaps could be a truth. And should I lose out? The fear of losing out prompts a decision which may not necessarily be the right decision for the investor fraternity. And too many options. So when 25 different sources tell you, you start believing that's the truth. And when I say you, it includes people like me as well. All of us as an investor fraternity tend to respond. This is a very good slide shared to me by my colleague Jigna. Dr. Malcolm Gladwell, if I recollect the name right. He has this theory of law of diminishing returns. Law of diminishing returns, agar simple language mein bolo to, the more you want to have something, the less you want to have more of it. It's something like that. So what it says is that, look, information to a point is helpful, but beyond a point, it starts getting into some level of paralysis in the way that you think, decode, and maybe too much of data points reduces the quality of that information that you wish to derive for the purpose it was originated for. To give you an example, this was a classic company which got destroyed because of social media. 71% of the value of this company got eroded in 1 day. 1 day. Because there was complete WhatsApp rumors which went across the market which said that they had a problem in their revenue recognition and they had a problem in their corporate governance, because of which the whole thing got completely wiped out, the market cap. Likewise, the ILFS fiasco, if you look at it, 3 दिन media में वही चल रहा था. And ultimately after 3 days, it has just died down. Now, why it originated, why it died down, those are matters of research which somebody has to go deeper into. But there have been so many people who have used that to transact. The classic case of Satyam in the past is also an example of that sort. So what we are trying to say through this second compartment of our discussion is focus on the facts. See if it is relevant to you. Ab duniya mein kya ho raha hai? I mean, if it is not relevant to the portfolio that you're holding, how does it concern you? Exercise restraint. So the first thing is, we say this internally in our theory of management, be in the process of elimination, don't be in the process of selection. So when you are in the process of eliminating and not selecting, jo last mein bachta hai, these are the ones those are relevant to us. We should, and I say this with no subjective interest of research and ranking, given the fact that all of you are already subscribers, you should engage expert advice of any sort that you think is relevant to that decision. At times you may be sitting on some very compelling facts or some very, very reliable resource who has given you those facts. However, if you follow the principle, the do's and don'ts that Manish spoke initially, if you follow those principles and you say that my expert advice, in the absence of which I will not put a rupee into it, if you follow that practice as a matter of clinical internal process, you would see that this will be a very good way of refining your thoughts and qualifying it to a progressive decision. And as they said, focus on really what matters. Develop critical thinking. Critical thinking, usme nuks nikalo. Figure out why it could not be true. As we said, it could be the extension of a thought of process of elimination. And when you see that, when you composite all these things together, you will find that your decision, your input feed of all the media, because they're going to only increase. If you see the first title that we have used in that is saying enhanced challenge. Because what you're seeing today is going to be in multiples tomorrow and going to be in quadruples in the times to come. So what you have to understand is, as a process, you will have to define some level of restraint, patience, formula in the way you're going to internalize that news. News to kam nahi hoga, news band nahi hoga. They will keep coming, they'll keep coming to you at a faster pace. But as matured investors, as people who have learned with time, progressing, it will be critical that you internalize and consume that news to the best of your abilities. The third part is a very interesting part. I spoke about this in the first session. It was India Rising in the first conclave that we had. Now, this is what I recommended, the Niti Aayog India at 75 report. A brilliant initiative, and all of you all should, in my opinion, read it. We have tried to take some data points, and thanks to Kunal, who's helped me put all those slides together, you will see that what we are saying is not too far away, And you can see that if you take a very positive view, there's a saying in the market, 98% of the wealth in the stock market is created by being bullish, by being a bull. By not by a bull, but by being a bull. So what it means is that essentially you will always look at the high points of where these are, but real facts. The idea is not to get enticed by certain data, but the idea is to look at how the quality of data and facts as they emerge are correlated to the economic principles of any country, and if they are relevant to India as an economy, and if yes, why shouldn't we as investors in the market make money? That's what we are trying to decipher through this. So the first aspect, which has been a telling statement made on the table by the reporters, what we are trying to do is change our league. Once upon a time, we were known as a country of the snake charmers, if you recollect. Then we progressed to be an economy of agriculture-based economy. Then we moved on to be an industrial economy and agriculture economy. And then services came over. Services just took us to a different league of being a reasonably middle-class economy. Today, as we speak, the telling statement that has been made is that we are trying to change our league to be an upper middle-class economy, so to speak. उसके लिए बहुत दूर जाने की जरूरत नहीं है. Our current economy is at 2.7 trillion. Okay? What it is saying is that you have to reach 4 trillion if you have to be where they're proclaiming us or guiding us to the point. And how can that be reached? If we can grow at a CAGR of 8% over the next 5 years, अगर 8% से आप अपना growth maintain करें over the next 5 years, you will see that it's a natural progression of reaching the 4 trillion mark, which is not only possible, it is highly probable. In the process, there will be a lot of jobs created, there will be a lot of infrastructure created, there will be a lot of positive movements. Let me tell you, we may have a cycle of what happened in US about 30 to 40 years back. The maximum millionaires in US were created about 40 years back. After that, the tech wave has created so many millionaires. But otherwise, if you look at the US economy, so many millionaires were created in that period of 10 years. And वही हमारे साथ भी हो सकता है. There may be a few people in this room who will also be a part of that. There will be so many new houses that will come in. There will be so many companies from the Nifty and the Sensex which will get displaced with new companies which perhaps is not existing today. So the rate at which these transformations are happening is something which is exceptionally good for India as a market, for we as Indians. The critical element here is, while we may all have our own view, and I perhaps lean a little towards the other side, what happens is, unlike most of the other countries, India will have to find a balance between the social and economic development. Because, mind you, we are in a phase of migration from lower middle class to upper middle class to the high class. So there are so many segments and so many economic stratas which are coexisting as we speak, and there is a migration of poor moving above BPL. There are so many of them who are moving to lower middle class. All of this will call the next 5 to 10 years in India will see a shift of a combination and a coexistence of socio-economic development. It may not necessarily be only or purely economic development. So you would see some more spends, and there are so many already happening, especially in the rural markets. So one of the first things that has been the Niti Aayog has recommended is that the GFCF, as they call it as, it has to move from 29%. It's currently at 29%. So GFCF is the concept of GCFCs. It stands for gross fixed capital formation. It's a component of your GDP. So GDP में से वो भाग which goes into fixed assets is called as GFCF. So it takes into account all the new additions of assets that is being made. It is called gross because it does not take into account the depreciation of the previous year's additions. However, it does not take into account your financial instruments. So आपके fixed deposits and all those inventories, all those are not computed. This is purely on assets acquired, capital goods assets acquired by the country in that period, which is normally a year. So if you look at the GFCF of the country, new investments, it is currently at 29%. It is recommending it to be moving to 36%. There's a slide on this, which is very interesting. The exports, Mani spoke about it being at 478. Okay, that has to move to about 800. And these are not indicators given by Niti Aayog. This is saying by the pure size of the economy, by the pure development of the market, by the pure skilled workforce availability, all of this. If we have to maintain our growth trajectory, these are natural corollary for where we could be existing at 2023. The exports currently, which is at 25%, which is currently at 19%, has to move to 25%. There's another slide on this, which is very interesting. Okay, tax to GDP, which is currently at 17%, which by the way, as compared to all the other OECD countries, we are almost at half. So if you take the Organization of Countries for Economic Development and Cooperation, you will see that they are in the range bound of about 36%. हमारे यहाँ पे अभी 17% है, but this has to move up. How is coming? Housing for all. There are going to be 2.9 crores houses in the rural sector, and there are going to be about 1.2 crores houses in the urban sector. All of this is also going to create a slightly different ecosystem of certain things that we had not panned out while we were planning about 5 years back. So these are new schemes which will take the country forward. If one has to take all those 4 or 5 broad factors of GFCF, exports, tax, and these prominent schemes of housing as well as roads and all that, you will see that the economy will reach from 2.7 to 4. I don't want to sound too simplistic, but if you look at it, you will see that it is something which is possible. Today, if you look at the composition of Indian economy, this is what the split is. There are 3 pillars on which our country is standing from an economic standpoint. One is agriculture, one is manufacturing, and one is services. Manufacturing, notwithstanding the data released yesterday, notwithstanding that, still if you look at it, we have another slide which tells you the detailing of this, but agriculture has been contributing at 17%, and what Niti Aayog is saying is that it has to have a CAGR of 10% to help you reach the 4 trillion economy. So agriculture apna bhag kar lega. Manufacturing, which is at 22%, it has to grow at 14% CAGR, which will also take you to that level of 4 trillion as we are expecting it to. Services. This has been the fulcrum or the load bearer of the economy. It has been always at about 58 to 61% if you look at the last 10 years. And ever since the services economy boom came in the country, you would have seen that services have taken a huge workload of the government, as well as it has helped us propel into what we are today and help us create a very strong foundation. This has to grow at 13%. Mind you, though 13% has to be on a much larger base of 61% of a far bigger economy than what it was traditionally. भी आप यहाँ पे देख लीजिए, if you see, generally what they are saying is, not that they've spoken in as many words, but what you can decipher from this is hold your balance as it is currently. Because Generally from 2012, if you see, agriculture has been in that 19, 23, and services has been 59. Yehi range hai. So the composition or the configuration is pre-decided. What we have to do is, because it is going to be on a much larger base, we have to be mindful that when the base increases, the percentages should not fall. And that's where a government will have its play. Even in 2018, if you see, 17, 22, 61. What we spoke in the previous slide. But if you look at it, it's gone to the least of 59 to the highest of 61, services. It's range bound. It's a pendulum model. It'll go in that swing. So we spoke about GFCF, the gross fixed capital formation. In this, we have to move from 29% to 36%. एक बहुत important बात यहाँ पे ये है that the government's participation. Now, when you say GDP, you have the spends of consumption, production, government investment, all of that come together, right? So, GFCF being a part of GDP, it is important to note that the government's contribution to that overall 29% has been just 4%. That's perhaps because of a little bit of lesser spends that has been done. However, Niti Aayog has recommended that the government has to change their spend structure and increase it from 4 to almost doubling it to about 7. And that's something that has been a strong recommendation with a rider that has gone in. When you see the report, you will see that. What they're also recommending is the incremental 3% has to go into areas which will help them build an ecosystem around that. So that will be largely in housing, infrastructure, which will lead to a lot of indirect prosperity in terms of jobs and other things. Let's be real about it. If you look at India and all the great growth stories that we have and the prosperity that we are, observing now, the reality also remains infrastructurally we are far behind in some of the countries even who are poorer. But we have to bear in mind that the huge landscape by the sheer size is so high that traveling at times can be a little difficult. अब आप यहाँ पर अगर देखोगे, the GFCF thing that we spoke about, the gross fixed capital formation, it's not something which India has not seen in the past. If you see 2012, there's been 34%. Even if you go to a year like 2015, it's at 30%. And only in 2019 and 17 and 18, we have been at about 29%. So what it is saying is, जो हमारा पहले का peak था at about 34%, it's saying incrementally go a little higher. Once again, I wish to qualify this on a much larger base. Because by the time when we say 2023, we'll be talking about a 4 trillion economy. And hence, 36% of that will be a large sum of disbursement. I correlate to that earlier slide that I spoke about. When you look at export, what they're telling us is again, Niti Aayog says that hold your exports at 25%. Even if you do 25% on the newer base, which basically means it's a huge in terms of the quantum leap, in terms of the quantum of and quantity of exports that you would do. And it's not a number that we have not seen in the past. इसके पहले भी किया गया है. So it is repeatable. So if you have done it once, it is possible that it can be done the second time, although on a larger base. The third aspect is the monetary policies, which I'm sure all of us know that, the investment, the interest regime, the policies on social development in the country, the policies on, finance regulations, and so many other stock market related aspects that has come in. Even if you look at SEBI, once upon a time it used to be an organization, without sounding too cynical about it. Once upon a time, SEBI did not have as much teeth that is. Aaj, everybody is very, very tight because they know SEBI has a lot of teeth. And hence you see market practices more often than not are the right ones. At least utne bulandi se log nahi karte hain as they used to do it in the past. So the tax to GDP ratio, we are currently at 17%, which is, as we spoke, almost half of the other OECD countries, which are roughly at about 35%. You can see this graph. You see Brazil at 34%. You look at, these are all tax collections, as a percentage to their individual GDPs. So 34%, South Africa is 27%, China is at 22%, and we are languishing at the moment at 17%. Having said that, What the government is saying is what Niti Aayog is saying is we are not going to jump directly to 34. So there is a calibrated stepwise model that has been recommended. So the next one that we are trying to move leftwards. First try and reach where China is today, which is a very, very comparable index. And you will see that if you go back, India at 17%, we are planning to move to 22%. Okay, and if this happens, this can largely, some of the exercises that obviously has not been well received, but even if you look at demonetization, you look at GST, all of this is start going to kick in its benefits now, because as a baby gets born, it's not going to start walk immediately. So all these policies will take its own evolution, it will take its own maturity, and all of it will start getting into this number going up. So what we are recommending is from 2018, where we are at 12,693, okay, Niti Aayog is recommending this to go up to 17,500, which, by the way, by all practical analysis, is a very possible number. Okay, so that's the other element. The consumption to be a major driver of the growth. So what is our current consumption? If you look at it, we are a 1.2 trillion current consumption, and they are talking only about doubling it. अभी आप अपने घरों में ले लो, खर्चा तो double हो गया होगा ना? I mean, if you look at it, when you paid, somebody gave the example of chai, and, it's also true. Most things have doubled. Most things have at times tripled, with the exception of things that we don't use, like a CD and all that, जहाँ पे rate गिरा हुआ है. But things which are in use, you look at we are so enthralled by the fact that when you go to all these malls, you see so much of rush, and people say there is inflation, पैसा नहीं है, margins कम हो गए हैं, टूट गया है. But you go to restaurants, it's so difficult to get a table. So today, if you look at the social evolution of metro markets, once upon a time, we used to walk into a restaurant presuming a seat to mil hi jayega. But today, most families have a habit of calling and reserving their table and reaching on time. From earlier, a walk-in model, to today, a pre-appointed model, which basically means there is a change in the consumption story. So 1.2 trillion becoming 2.5 trillion in a period of 5 years. In that sense, agar aap logon ne apna kharcha double kar liya, we will reach there. And government will play its own part in terms of the spends on the social sector and the rural sector schemes that it has, and which is not only an economic but also a political compulsion for anybody who comes into power. So consumption story, for this we have to move at 16%. Like if you go by the R&R principle, if you grow at a CAGR of 38, if you move at 38%, you reach 5 by 5. So likewise, if you do a CAGR of 16% here, okay, by 2023, your consumption will double. As Manish spoke about initially, we are largely immunized to global trades because India as an economy is a consumption-led economy. Which means is, दुनिया किधर का कुछ भी हो जाए, as far as we are concerned, our consumption is going to increase. And what we are saying is over the next 5 years, this consumption from 1.2 should be moving to 2.5, which looks to be a very, very achievable number. And this also indicates an enhanced per capita income, which is coming here. So currently we are at 1,27,450. It is once again recommending an enhancement, because only through your enhancement of per capita can the consumption lead, because ultimately it's not going to go free. It has to be paid, and that can come in only when the income rises. And that's what you see. The per capita income of a country by 2023 is expected to be at 185. Infrastructure. This is a sector that, now when we say infrastructure, the general perception in the market, real estate, mar gaya, this, that, all of it, which by the way may be true also. But what we have to understand is a country of our size, when the government becomes a sizable spender, it is moving an elephant. There's a sheer size. There's a sheer strength that comes along with that. And all of it, you will see that infrastructure has been a key focus area over the last 4 years. A very valid data point that Sanjeev spoke about how roads have more than doubled in a period of 4 years. All of this is going to create so many extensions around those individual areas. There's a very proverbial saying, did America make roads or roads made America? There's a very proverbial saying, and the fact is that roads made America. America, to be building on the perception of what it is as a rich, powerful country, came up with the smooth and swanky roads which they had when most other countries did not have. So they became a display model. This sector is also up for employment generation. The problem may be the other way around. I mean, being in some of the other businesses, what we observe is the general propensity for people to pick up jobs which are labor-oriented is decreasing. These are some of the other aspects of, aspiration. So today, I don't think you all will have a house help, say, 20 years down the line, because nobody wants to be one. And even if they are, the cost will be so high that you may find it MAID for each other, using his metaphor. So now, we have total projects of about 25 lakh crores, which is already on the market as far as road is concerned. And what we are doing is we are creating some wonderful physical connectivity, which is coming in this. There's some marquee projects in the, I don't know, any of you know about Bharatmala as a project? Amazing. I mean, it's wonderful vision and so far wonderful execution. A great minister at work. And, Bharatmala is going to connect 550 districts in the country. Our current connection is only at about 280 or 300. I don't remember the figure correctly. But I think roughly about 300 districts are connected as we speak. This is going to connect about 550, districts. About 84,000 kilometers of road being developed. And about 40 logistics hubs being created, which currently I believe is at about 6. Just imagine what's going to happen in the next 5 years as far as this is concerned. But you look at, when you look at data points of why some of these companies are finding it difficult, because industries which are labor intensive, people don't want to work as hard. And even if you go to a construction site today, you are not allowed without a helmet. Ek time pe, rassi pe chad ke, people used to do everything. But those safety standards, those inward resistance for them to come in, individual growth in different markets, all of this is changing the direction in which labor was moving once upon a time. There are 100 smart cities being developed. I don't know if you all know about the Sagarmala project. Anybody? Yeah. So Sagarmala is a coastal development project. What it is going to do is, I don't know how many of you all have gone to Oman. Oman, contrary to what the whole world believe, is not completely oil-dependent economy. It has one of the best ports in Middle East, and as a matter of fact, all Middle East countries to a great extent is dependent on Oman for their shipments. They are one of the best, and geographically they are in a position where they get a lot of benefits in terms of where they are and cutting down the shipping costs. So Sagarmala is going to develop, if I recollect my memory right, we are also a part of that project in one of our other companies. So I believe it's some 14,500 kilometers of navigation or things like that, 7,500 kilometers stretch that is going to be developed. There are going to be about 140 logistic parks that is being created in that space. So it's going to create an economy which was never there. Once upon a time, it was just lying idle. All of a sudden, it has become a very, very rich land for all of them who are there. If you look at the Mumbai-Ahmedabad bullet train, the controversial one, okay. Likewise, you have the Amravati capital city. This is going to be another, I don't know if anybody of you all seen online the capital model that they've built. This may perhaps, because they have the advantage of knowing what to do, given the fact that they're doing it much later in a very advanced India. So Amravati capital city is a wonderful project that is on display, and we all know what the Chief Minister is doing there. So to sum up my presentation on the 3 compartments that we want to speak about, is the first thing is exciting times ahead for India and Indians. I think all of us, we also need to, in that sense, be humble enough to respect the fact that we live in such times, which perhaps our parents were not. I'm not even sure if our children are going to see such great times, because it's always easier to grow in a market which is growing. Americans made the most of it 40 years back. Indians will make it today. We don't know if our children will be as fortunate in terms of getting an India which is growing at a similar rate at what it is growing today. So these are wonderful times for India. These are wonderful times for Indians. What it needs is phenomenal maturity to look at and understand and appreciate the opportunity. Imbibe that there are risk factors, because everything is not, in absolute. The demographics are constant. Isme to koi ladai nahi hai. If the average age is 26, it is 26. If it's going to be 24 after 3 years, it is going to be 24 after 3 years. Unless we have certain very, very bad natural or anything of that, all these economic parameters are largely stable. So the demographics will stay, the income aspect will stay. Look at education. Sanjeev spoke about electrification. These are all truth. Ye sab hua hai. And by this, just imagine a small handheld device that you have today, how it has changed your own world. And how, imagine it is going to change the world once upon a time. 2000, when we bought such a big Nokia phone, voice was a commodity. Our only job was to speak. Then came the wonderful thing of SMSing. Then came, today, voice is just a commodity today. I mean, baat aap kam karte ho, use it for most other purposes. And that's the India that we are all proud of. Likewise, as investors, okay, we do this, and we are not advising anything that we are not preaching anything that we don't practice. If you look at the way we manage our own monies also, the reality is if you don't take a long-term view, okay, you have to be a skilled trader to make money. Very interestingly, Rakesh Jhunjhunwala's interview about 1 week back in E.T. Panache, and he spoke about, without sounding sexist, I should say this, he spoke about trading being the mistress and long-term being the wife. I presume that the single most thing that connects all of us here is the fact that we believe in the long-term story of the country, And the long-term story of the country says that if we have to identify stable stocks, fundamentally strong companies, you will always tend to make money in the long run. How long is a question of, how long is always a question, So knowledge and information about market is the key to wealth creation. And when we say market, more relevant to your stock, more relevant to those 6 or 8 parameters that we spoke about, and be mindful about the fact that there are about 1,000 more. So how deep are we going to do? How kam bore honge hum log ye karte karte? It is many a time what happens is you get more information, then the interest levels start dipping in. So it is important from our side to appreciate that we are living in an information age, and information will come to you in multiple formats. Consumption of that, trusting who you want to listen to will determine the way your wealth will be created or eroded, as the case may be. The final point that I want to make is research and ranking, and I say this with no subjective interest. Manish touched this. I want to elaborate a little bit. Research and ranking or platforms like this, in my view, will have an enhanced role in your lives as you go forward. So if you are used to this platform for half an hour a day, with each progressive month, you will see this increasing a little, or each progressive week, whatever is your frequency, okay? So I think the leadership team at RNR is also doing the right thing, and I have the advantage of being inside and outside, And so I see always research and ranking from an arm's length distance. And I see that the customer engagement initiatives that has been taken up, okay, will go a long way in enhancing the trust levels, understanding the challenges and opportunities both, and more importantly, using it as one of your tools of your daily lives, so to speak. So I hope, and at the same time, I believe that research and ranking and all of y'all as a part of our ecosystem will continue to have a far more engaged relationship in the times to come. It's not about subscription. It's just the start of the journey. It's about utilizing the thousands of hours of rich minds that go into building what we are building. So when you get a report from us, it may be a 10-minute read for you or a 1-hour read for you, but there are quite a few 100 hours that go behind before something is submitted. So appreciate that fact, choose it to your discretion. We are not saying listen to what we are saying, but what we are saying is patiently understand what we are attempting to make, and in the process, we hope you, we, all of us, create a lot of wealth in the market, which helps India to be a far better society, which helps India to be a far bigger country than what it is currently. So with this, if I may be allowed to conclude my presentation, like the infamous Henry VIII said, I won't keep you holding for long. Yeah. So thank you very much. Look forward to speak to you over lunch.